Aldrich Pump files Texas two-step plan documents splitting current and future asbestos claims. DBMP asbestos claimant representatives object to amended trust funding agreement. Mallinckrodt files amended plan memorializing global opioid settlement resolutions with note holders. Hello and welcome to the Reorg Podcast, where we bring you the latest developments in high yield, distressed debt, and bankruptcy. I'm Julian Boulogne. Also this week, Judge Phillips denies ad hoc committee's motion to appoint examiner in Intelsat. For this week's deep dive, Reorg's Edward Cerullo, Sean Daly, and Kyle Owusu discuss developments in the ongoing Latin American airline Chapter 11 cases, including Avianca, LATAM Airlines, and Grupo Aeromexico. It's Friday, October 1st. Last Friday, September 24th, the debtors in the Aldrich Pump Texas two-step Chapter 11 cases filed a plan support agreement and placeholder plan of reorganization, providing the latest blueprint for future Texas two-step mass tort Chapter 11 cases, including a potential filing by Johnson & Johnson to rid itself of talc liabilities. Under the PSA, the debtors, the train operating entities, and the Future Asbestos Claimants Representative, or FCR, agreed to cash out the operating entity's ongoing asbestos liability for $545 million and to allocate the bulk of the settlement payment to future claimants represented by the FCR. If the plan is confirmed, the non-debtor operating entities would receive releases and injunctions protecting them from all current and future asbestos claims, which would be channeled to the trust established by the plan. The debtors also filed a motion to estimate their current asbestos liability to claimants that manifested disease prior to the petition date at no more than $125 million, the amount of current asbestos claims agreed to by the debtors and the FCR and the PSA. The debtors state that they believe that the estimation proceeding, which would occur prior to confirmation, would take approximately 1 year. The debtors suggest in the estimation motion that the Asbestos Claimants Committee, or ACC, will contest both the necessity of an estimation proceeding and the proposed $125 million amount for current asbestos claims. At a status conference on Thursday, Judge Whitley told the parties that he would likely schedule a hearing on the estimation motion in November or December. On Wednesday, September 29th, the official Asbestos Claimants Committee in the DBMP Texas two-step case, also in Charlotte, objected to approval of an amended asbestos trust funding agreement between the debtor and CertainTeed LLC, the operating entity that emerged from the Texas divisional merger that also created the debtor. According to the ACC, the amended funding agreement is yet another stratagem to extinguish fraudulent transfer claims that would unwind the divisional merger and defeat the pending request to substantively consolidate the debtor's estate with CertainTeed. The ACC points to findings in the proposed order approving the amended funding agreement as evidence of the debtor's ulterior motives, including findings that the amended agreement is fair and equitable, in the best interests of creditors, valid, and enforceable. These proposed findings demonstrate, the ACC says, that the amended funding agreement and the proposed order are designed to cleanse and shield the corporate restructuring from creditor challenge and judicial scrutiny. The ACC argues that approval of the amended funding agreement is not in the best interests of creditors because it allows the debtor and CertainTeed LLC to continue to push a time-consuming and costly estimation proceeding in the hopes that the asbestos claimants' representatives will settle for asbestos claim funding that will be far less than warranted in light of CertainTeed's extensive asbestos liabilities. Additionally, the ACC maintains that the amendments to the funding agreement trumpeted by the debtor are window dressing that has more gloss than substance. Among other things, the ACC argues the new prohibition against payment of dividends by CertainTeed LLC would not halt CertainTeed's current practice of upstreaming cash to affiliates, including ultimate parent St. Gaubin, in the form of loans. The ACC also argues that CertainTeed LLC would still be free to incur unlimited debt that would be senior in priority to its obligations to fund the debtor, and CertainTeed LLC is expressly permitted to engage in consolidations and mergers and to transfer all or substantially all of its assets. On Wednesday, September 29th, the Mallinckrodt debtors filed a long-awaited amended plan of reorganization incorporating previously announced settlements with the Official Committee of Unsecured Creditors, the Official Committee of Opioid Creditors, second lien note holders, and the holders of their 4.75% and 8% legacy notes. Under the amended plan, a GUC trust would be funded with $135 million in cash, contingent assets, and certain causes of action. Consistent with the prior plan, guaranteed unsecured note claims stand to receive 100% of reorganized equity subject to dilution, with first lien claims receiving cash or new cram-down debt, including provisions accounting for an anticipated make-whole dispute with the first lien note holders. Second lien note holders would receive new second lien notes, with no allowance for the second lien make-whole. The amended plan also provides for an additional $125 million payment to opioid claimants on the 8th anniversary of the effective date, subject to the debtor's prepayment option during the first 18 months after the effective date. The amended plan faces additional headwinds, however, due to a ruling by Judge John Dorsey on Wednesday, which denied the Mallinckrodt debtors' motion for partial summary judgment on the administrative Okthar claims asserted by Humana and Attestor, on the basis that the claims were post-petition claims rather than pre-petition claims stemming from earlier alleged misconduct. As a result, if the debtors do not prevail at a trial on the merits of the administrative claims, the Okthar claimants may be able to challenge the pricing of Okthar on antitrust and other grounds after the debtors emerge from Chapter 11, which the debtors have said could endanger the plan. At a hearing on Wednesday, Judge Keith Phillips denied a motion to appoint an examiner filed by the Ad Hoc Committee of Intelsat SA equity holders, sustaining objections lodged by the debtors, the Official Committee of Unsecured Creditors, and other plan proponents. Looking ahead to the upcoming confirmation hearing scheduled for November 8th, the court determined that it was unrealistic to think that anything meaningful could be done by the examiner before confirmation. The debtors argued at the hearing that appointing an examiner at the current juncture, 473 days into the case and 40 days from confirmation, was not appropriate. The debtors added that any delay in the confirmation timeline was inappropriate due to the, quote, staggering carrying costs of the case. The debtors also added that all issues raised in the examiner motion can and will be determined at confirmation. Judge Phillips denied the motion to appoint an examiner without prejudice, should confirmation not go forward as the debtors expect. Top red stories this week included unrestricted subsidiary transfers threaten to split lenders into haves and have-nots, potentially deprived of secured status in Chapter 11, often lead to acrimonious litigation. Moby accuses DeMeo, Morgan Stanley, of trying to scuttle restructuring, seize control of company through economic piracy, seeks injunction to bar defendants from purchasing more notes. PJM generators to face further headwinds as FERC orders market seller offer cap change. PJM requests auction delay to January from December. Go bond CVI bill contemplated in Commonwealth Plan of Adjustment filed in Puerto Rico legislature. Oversight Board voices support for pension municipal finance initiatives. Now here's Jim from Houston with the week ahead.
Good morning and welcome to the week ahead. Monday, October 4th, Ultra Petroleum returns with oral arguments in the make-whole PPI appeal before the Fifth Circuit. And in Forever 21, a dismissal conversions motion hearing. Tuesday, October 5th, Stoneway Capital, second exclusivity extension hearing. Wednesday, October 6th, omnibus hearing in Puerto Rico. And Thursday, October 7th, a repledge procedures hearing in Corp Group Banking. And that's it from me. Back to New York.
And next up, Reorg's Edward Cerullo, Sean Daly, and Kyle Owusu discuss progress in the ongoing Latin American Airline Chapter 11 cases, including Avianca's vote solicitation on a plan of reorganization and expected plan filings by LATAM Airlines and Grupo Aeromexico.
Hi, I'm Sean Daly, distressed debt legal analyst for America's Core Credit by Reorg. And joining me on the podcast today are Kyle Owusu, Director of Emerging Markets Credit Research, and Ed Cerullo, LATAM Corporate Credit Analyst. We'll be discussing the current state of play in the major Latin American Airlines Chapter 11 cases. Avianca is leading the way with a proposed plan of reorganization already out for solicitation, while LATAM Airlines and Aeromexico just need the proverbial 5 more minutes, please, to get plans on file. Kyle and Ed, welcome.
Thanks, Sean. Glad to be here.
Thanks, Sean.
Okay, so let's start with Avianca. As we noted a minute ago, the debtors have a plan on file. The disclosure statement has been approved. The UCC supports the plan. Confirmation hearing scheduled for October 26th. No major roadblocks to confirmation. A couple minor disclosure statement objections that were overruled. So, Ed, this one's looking pretty baked. Maybe you could walk us through the plan details.
Sure. Thanks, Sean. First and foremost, the plan contemplates a $1.6 billion DIP to exit facility that would see the DIP A tranche repaid in full, essentially by a one facility of $1.05 billion and an A2 facility of $550 million that would effectively convert into 7-year paper after the emergence date and carry a 9% coupon. The restructuring plan is also predicated on the equity conversion option for the Tranche B DIP claims and an additional concurrent equity contribution by certain Tranche B lenders. Specifically, certain Tranche B lenders, including United, have agreed to provide an additional $200 million of value in exchange for an incremental allocation or 21% of reorg equity issued at a pre-money valuation of $800 million. Specifically, United can elect to participate in the contribution through providing aircraft. The other party to this additional equity contribution are Kingsland, GRI Capital, Elliott, South Lake One, Citadel, and Moneda.
And I think it's worth sneaking in, sorry, Ed, before you go on, just a quick note that the debtors are relying on the marketing process they ran starting in the spring to see if anyone was willing to provide new capital on terms more favorable than this Tranche B equity conversion. It sort of came up at multiple hearings over the spring and summer. This is the deal that they arrived at. So they're kind of relying now on, well, you can impute valuation from this. Here's where the market cleared to support valuation as opposed to filing a separate, summary valuation analysis or anything in their disclosure statement. So sorry, Ed, maybe onward to unsecured claims.
Sure. Yeah. So in terms of distributions to unsecured claim holders, the plan provides that unsecured Avianca claim holders have an option to receive either a pro rata share of consideration in cash or 1.75% of equity and warrants for 5% of reorg equity. The aggregate warrant consideration is valued at $16 million. An additional 0.75% of reorg equity would be available for distribution to unsecured creditors if the class as a whole elects to accept the plan. So in aggregate, what does this look like in terms of recoveries for unsecureds? We have 20 million or 2.5% of the 800 million pre-money valuation plus 16 million in warrants or 36 million in total in cash or shares plus warrants. In terms of recoveries, assuming that the 9% notes are effectively unsecured per the DIP marshalling provision, and 129 million of those non-roll-up 9% notes remained outstanding, plus an additional 65.6 million in holdout 2020 notes from the previous exchange, and 53.2 million in unsecured credit lines. That leaves us just under 250 million in unsecured claims, or roughly 14.5% implied recovery. We also note that per the disclosure statement, they're showing unsecured claims with a recovery of 1 to 1.4%. Moving back to the Tranche B lenders.
Sorry, real quick, Ed. And where are those notes that you just ran through? Where are they trading right now?
Yeah, so the 9% notes are trading sort of in context of 16 cents on the dollar, which would sort of dovetail with the 14.5% implied recovery that we're estimating. Thanks for mentioning that, Sean.
Yep.
And just moving back to the Tranche B lenders who would effectively receive the remainder of the equity distribution, or 76.5%, assuming that the unsecureds take that deal and get the full 2.5%. Previously, the debtors had estimated that the Tranche B claims were roughly 935 million. The equity conversion motion references $900 million and $940 million figure. Note that this tranche began with a principal amount of $722 million and grew on account of capitalized interest and fees over the course of the bankruptcy.
Gotta love that pick.
Yeah, and effectively the exit notes, together with any amended restated secured debt and the new common equity plus warrants, will constitute the entirety of the debtor's pro forma capital structure. Naturally, the equity distribution is subject to dilution by shares issued in connection with the warrants and any shares issued pursuant to a management incentive plan at the directive of the reorganized Avianca board. Turning to plan valuation, it's effectively showing a total enterprise value of $4 billion, assuming the roughly $3 billion pro forma net debt per the debtor's business plan, and the $1 billion in equity based on the $200 million of new equity struck at an $800 million pre-money valuation. We see this is in line with fair value assessment based on 2022 expected EBITDA of $667 million, which we capitalized at 6 times. We note that this is sort of on a forward valuation basis. This is lower than the likes of Azul, which trades at about 8.8 times, and we're using this lower multiple because we believe that the execution there's a higher degree of execution risk with respect to the debtor's business plan. Speaking of which, the Avianca intends to embark on a new strategic direction that marks a shift in strategy, seeing the company pivot from a low cost carrier model based on a core business of narrow body aircraft operating on a hybrid hub and point-to-point network. This also entails a transformed cost structure with total system airline cost per available seat kilometers or CASK, excluding fuel, projecting to fall by more than 41% by 2023. It would also entail a dramatic fleet cost reduction, with average fleet cost ownership expecting to be reduced by more than 35% through the replacement of existing aircraft and repricing of lease agreements on current market terms, as well as through the densification or upgauging process, further reducing unit costs. The company also expects to see a significant financial deleveraging, with net debt to EBITDA projecting to decrease below 3 times by 2024, when the company expects to generate $1.15 billion in EBITDA. The company is projecting total debt to range from $4 to $4.4 billion between 2021 and 2026, and increase to $5.3 billion by 2028, mostly on account of additional aircraft financing related to new operating leases and deliveries via the Airbus order from 2025 onwards. Net debt is expected to decrease from just over $3 billion in 2021 to $2.3 billion in 2028, leading to a reduction in net leverage from 5.1 times to 1.4 times.
Thanks, Ed. I think this cost structure point is maybe an interesting segue into LATAM. They filed a few weeks ago with cleansing materials deck, including a slide showing this cost per available seat kilometer, or CASK, ex fuel, for a bunch of different airlines. You've got GOL at 3.7 cents, then LATAM, depending on whether you include the cargo business, at 4.2 to 4.5 cents, Azul at 4.6, and then up in the stratosphere, terrible pun intended, you've got Avianca at 6.2 cents. So is the Avianca cost structure here, and maybe with a grain of salt, because it's being shown in a comps table by one of their competitors, is that 6.2 cents in 2019 terms consistent with what Avianca has disclosed?
It is. Thanks, Sean. And indeed it is. They showed a CASK ex fuel of roughly 6.17 cents in 2019, and are showing a passenger CASK ex fuel of 3.48 cents by 2023.
Which would be the lowest sort of that historical comparison. So, I mean, that would put them cheaper than LATAM if they sort of fully follow through with their anticipated cost-cutting strategy?
It would. Ultimately, depends on the magnitude of the cost transformation of LATAM, and again, sort of speaks to the degree of business execution risk that both these airlines face.
Yeah, so maybe just ending on that point, how much of the cost cutting has already been realized versus, are we talking about a plan that's kind of multi-year still? Those future EBITDA numbers are baking in some anticipated cost savings.
Yeah, it remains ongoing. They're expecting to generate about $500 million per annum in cost reduction, plus structural changes to fleet and network to be realized through 2023.
Great. Well, thank you very much, Ed. We'll come back to you in a minute to discuss Aeromexico, but I think maybe a good in between, because we've just been talking about them, to turn over to LATAM Airlines, where there's no plan on file, but there is an illustrative plan term sheet that the company put out on September 10th with some cleansing materials. And they're operating under a short extension of their exclusive period to file a plan until October 15th. Kyle, could you maybe kick us off by running through who the key players are as we approach this pivotal point in the plan process?
Yeah, sure. So you've got the ad hoc group of bondholders who filed a statement disclosing 1.6 billion of total claims sort of across the capital structure on July 22nd. I would note that within that you have 731.2 million of international 2024 and 2026 bonds that are held by the group, and there's 1.5 billion of total 2024 and 2026 unsecured bonds. You've also got the ad hoc group of parent unsecured creditors who filed a statement as of July 12th with showing 5.2 billion of total claims against total claims across the capital structure. Interestingly, in that filing, there were 4 billion of claims against LATAM and certain related claims against LATAM subsidiaries. You've also got the ad hoc committee of shareholders who filed showing 3.5 million of shares as of August 17th. I would note that Columbus Hill Capital Management disclosed that 12 million shares and other unspecified claims, and Sean will touch on their role in the proceedings, I'm sure. And then the existing pre-petition shareholders here are playing a pretty significant role. You've got Delta, Qatar Airways, and the Cueto family. Then moving to the DIP providers, the DIP Tranche A lead is Oaktree. You've got additional Tranche A providers in Knighthead, Qatar Airways, and Cueto. In the Tranche C, there are the Jefferies creditor syndicate, as well as certain other minority shareholders. And Oaktree and Apollo have proposed a 700 million Tranche B DIP, and the debtor filed that motion very recently on September 29th. I would also note that Apollo, Knighthead, Certares, and other LATAM Airlines bondholders and unsecured claim holders signed NDAs to access the debtor's plan and discuss Chapter 11 terms. That was around roughly mid-August. Knighthead, Apollo, and Certares, as many people know, that trio's restructuring proposal was selected by Hertz in those proceedings as the winning proposal. Knighthead and Certares have invested in LATAM Pier Azul through convertible notes. Apollo is the lead investor in the Aeromexico DIP, which I would imagine that Ed will touch on. And Knighthead also participated in LATAM Airlines DIP, as I noted above. So these investors are clearly no strangers to the travel and leisure sector.
Thanks, Kyle. Yeah, that COVID demand recovery trade. If you like it once, you might like it 3 times or 4 times.
Exactly.
So can you maybe take us then through some key details from this plan term sheet?
Yeah, sure. So starting with the secured portion of the cap stack, you've got 300 million of admin claims, 1.4 billion of DIP Tranche A, 1.5 billion of DIP Tranche C, and those are set to be repaid in cash. Then you've got a 603 million revolving credit facility and a 273 million spare engine facility, which are expected to be either refied or renegotiated with a maturity extension. There's also 292 million of other secured claims, and then 10 million of priority unsecured claims with treatment TBD, either unimpaired or impaired based on plan value and allocation of value. Then you've got 1.5 billion of unsecured notes, and those creditors are slated to receive plan recovery reorganized shares subject to dilution from the management incentive plan and or cash in accordance with the rights offering process. And you also have 5.9 billion of other unsecured claims, and the treatment is similar. You've got planned recovery reorganized shares subject to dilution of the MIP, and or cash in accordance with the rights offering process. Finally, you have the existing equity, and they are slated to receive the right to invest in new value in the rights offering.
Great, thanks for that rundown. Let's maybe unpack the rights offering a bit, because this is where things get interesting. Sort of what are unsecured notes versus pre-petition equity getting?
Yeah, definitely. The use of it's a 5 billion rights offering for starters, and then the use of proceeds. You've got 1.8 billion of cash going to the balance sheet, 1.4 billion going to repay the tranche A dip, and then 1.5 billion going to repay the tranche C, with 300 million repaying admin claims that are incurred as part of the debtors Chapter 11 in cash. And I agree, this is definitely where things get interesting in terms of some of the potential Chilean law issues, which I'll leave to you to discuss.
Yeah. Full disclaimer, I can find Chile on a map, but that's about it. So these are, this is paraphrasing from restatements of the law in various pleadings over the course of the case. But yeah, it's sort of, there are two Chilean law issues implicated. One, to raise equity capital, a public company must amend its bylaws via shareholder vote. And then two, all shareholders have the right to participate pro rata in any equity raise through these preemptive rights. And you can also you can waive or transfer the preemptive rights. So how does this get addressed in the term sheet? The debtors note, hey, first we'll have a shareholders meeting, and then when you're thinking about pre-petition equity here, there's a subset of facilitating shareholders, they're called, which that could be Delta, Cotter, Cueto family, just kind of reading between the lines here, that will agree to do two things. One, to vote in favor of any needed shareholder resolution. So, debtors more or less have that locked in. And then they will, in their bullets, still blank in the term sheet, for these parties to agree to, retain, assign, or waive all of their preemptive rights. So retain, you're exercising those preemptive rights. Assign, they'd assign, X percent to the backstop parties. So that's how you get the backstop parties. They're a little bit of non-pro rata juice. And then the waived rights would go, the defined term is unsecured creditors investment rights. And maybe you could take us then through, Kyle, how this, with this kind of funky structure, what are the multiple rounds of the rights offering?
Sure. So round one of the rights offering is going to be the preemptive rights offering, which will be offered for subscription to shareholders in accordance with Chilean law. LATAM parent shareholders who, as of the record date, do not waive or assign their preemptive rights are going to have the right to purchase for cash at plan value their pro rata share of any reorganized shares that are issued as part of the plan. And cash proceeds that are received from the remaining, so non-backstop or facilitating shareholder groups, will be paid in cash to unsecured creditors. I'm sorry. Shares that are not exercised in the preemptive rights offering round are going to be retained by LATAM Airlines parent company and then placed in an unsecured rights offering, which would take place after the preemptive rights offering. Under the unsecured rights offering, these shares that are not exercised, which are called the backstop reorganized shares, would be offered to all unsecured creditors on a pro rata basis based on plan recoveries. And then finally, any backstopped reorganized shares that are remaining after the unsecured rights offering would be subscribed or acquired for cash by the backstop parties and any other parties that are interested in acquiring shares as may be agreed by the backstop parties.
Great. Thanks for that rundown. So it's sort of equity gets the first crack, then unsecureds, and then like anything else, if there's anything left over, that's where the backstop comes in. So I guess just to noodle on the preemptive rights, there are really kind of two legal issues before we move on. One, in various parties' responses to the debtor's latest request for exclusivity, they start tiptoeing around some plan flavored arguments. The UCC, the parent ad hoc claims group, just kind of raised a flag and said, whoa, until we mighty unsecured claims are paid in full, the absolute priority rule says, no dice on value flowing lower than us. Columbus Hill, as you noted earlier, it's got 12 million shares or so. They filed a nice response, which about as politely as you could said, hey, have you dummies forgotten the new value exception to the absolute priority rule? And the debtors, for their part, sort of step back, but also, they said something along the lines of, oh, don't forget, absolute priority rule only kicks in if we're in cram down. So, kind of a suggestion that if we can get enough unsecured creditors on board, like whatever, this isn't a deal. But I think the new value exception is really the better point there. And then one other legal issue before we go on, which kind of goes back to unsecured recoveries. The company showed when it filed its schedules and statements late last year, and I think, Kyle, you had the eye on this. Originally, they showed a lot of value in some intercompany receivables at entities that had issued some U.S. dollar bonds, and so it kind of looked just based on those basic facts, like, oh, okay, U.S. dollar bonds maybe have a few extra sources of recovery, as opposed to bonds that were only issued up at the parent and didn't sort of have these other entities. It caused enough heartburn that a local law Chilean bond trustee filed a motion for partial substantive consolidation earlier this year, essentially making the argument, hey, these other boxes were only created for the U.S. dollar bonds, as for tax and structuring quirks. We all sort of thought we had the same credit support, so there's it would be hugely unfair if these U.S. dollar bonds had some other source of recovery, and so we've gotten ourselves into Schrodinger's intercompany balance here. It exists, maybe, or maybe it doesn't. The debtors have sort of disclaimed any reliance on representations about intercompany balances. They may change. Plan term sheet appears to treat all unsecured claims the same. You can allocate different claim amounts at different boxes, maybe. But then this request for partial substantive consolidation, the court held a hearing in July, and Judge Garrity, this local bond indenture trustee raised a whole parade of horribles argument, and Judge Garrity said, made some comments along the lines of, well, all right, you guys made an assumption, turned out to be wrong. I'm not seeing an issue here, which I wouldn't read necessarily as him saying, yes, I bless the fact that there are these extra sources of recovery, and more just like, hey, I don't know, they kicked the can. The debtors said, until we file a plan that actually raises this argument, this isn't even an issue that's ripe for discussion. So I wouldn't, the judge didn't seem to have any issues if the debtors wanted to show up in court and allocate value, in whatever way they're going to say as part of a global resolution. So just a couple legal tales to keep an eye on as things go forward. But maybe more importantly, Kyle, you could take us now to just kind of thinking about the business, thinking about valuation.
Yeah, sure. So as Sean touched upon, there are various potential disputes in this case, and as I mentioned, there are a few separate different constituencies and groups, and that all sort of points to one direction or one idea, which is that there are a few people out there that think there's a lot of value in this company. The question or the debate, I should say, more accurately, is going to likely come down to how that value gets allocated. And so the question is, how is the company getting there in terms of justifying the value that people are seeing, and what does this recovery look like, or what does the company forecast that the recovery looks like? And so just running through firstly some of the top line assumptions. The debtor put out a cleansing statement or released rather cleansing documents, sort of pointing to a domestic market recovery driven by Brazil and Chile, followed by Peru, Colombia, and Ecuador. The assumptions sort of bake in a 15% permanent structural gap with regard to business travel, but that's expected to be offset somewhat by a 12% improvement in U.S. long-haul routes driven by the joint venture that LATAM Airlines has with Delta. The forecast call for long-haul demand in the long-haul market to recover to 105% of 2019 levels by 2024. And interestingly, I think with regard to the top line and just in general, 2022 and 2023 are key years as the company forecasts that it's going to ramp up its available seat kilometers or ASKs by 55% year on year, from 71 billion ASKs to 110 billion. Then followed by that spike, another 23% year on year increase to 135 billion by 2023. So that's sort of the top line with regard to the passenger segment. Then if you move to the cargo segment, I mean, interestingly, the debtor is anticipating that this business can grow to 1.7 billion of revenue by 2024, compared with 1.1 billion in 2019, with cargo moving from 10% of total revenue pre-pandemic to about 14% by 2026. And so that's the top line. And then I think it's similar to Avianca, and just I would imagine a theme that you're probably going to see with Latin American airline restructurings, but just in general with airlines across the board as they look to cut costs during the pandemic. LATAM is forecasting EBITDA margin expansion, with EBITDA margin reaching about 21.1%, which is roughly 2019 levels by 2024, but then continuing to expand in 2025 and 2026, where the EBITDA margin is as high as 25%. And you've got a 36% roughly incremental margin in 2023, followed by a 36% incremental in 2024, 38% in 2025, and 40% incremental margin in 2026. So you can really see here that the debtor or the debtors are obviously estimating an increase in profitability. Now, I would note that in the model, they've disclosed that they're holding jet fuel flat at $73 a barrel. So we'll have to see sort of how any potential increases in crude oil or rather in jet fuel prices can impact those estimates. A very important element of the debtor's plan is this conversion from fixed to variable costs. And a key part of that is negotiating or renegotiating, I should say, the contracts under its various aircraft from fixed payments to power by hour, which basically means that you pay based on how much you fly. So about 60% of the debtor's narrow body fleet is projected to be on power by hour agreements until 2022, and then 50% of the wide body fleet is expected to be on power by hour agreements until 2023. And so again, that just goes to show, or goes to highlight how important those 2 years are, 2022 and 2023, in terms of being key years where the debtor's activity is expected to ramp up, and the costs will sort of transition back to more fixed in nature. So if you don't get that ramp up, that could be problematic. Another reason it could be problematic is that you've got in 2022 a $900 million cash outflow, leading to a projected $142 million cash balance at year end. Now the debtors are obviously anticipating that cash balance will increase, but nevertheless will increase, to about 1.4 billion by 2026. But nevertheless, it just highlights the risk, I think, inherent in the plan, that you don't have a ramp up of activity in 2022 and 2023. And so moving to valuation really quickly, one very key point here is that the debtors put out low and high estimate claims, and I think the key point with regard to those claims is that you've got 6.9 billion of low estimate unsecured claims and 8.7 billion of high estimate unsecured claims. So depending on how the claims process and the claims estimates shake out, you could see some dilution there. The debtor is estimating a pro forma capital structure that has 3.4 billion of net debt, so 6.2 billion of total debt, including operating leases, and 2.8 billion of cash. And I think Ed touched upon Azul trading at around just over about 8.5 times its fiscal 19 EBITDA. So if you apply a 7 to 9 times range to LATAM's 2024 EBITDA estimates of 2.2 billion, plus or minus 10%, that can get you to a low case valuation of about 14 billion. If you discount that multiple range a bit, by like 25% and use 5.25 to 6.25, 5.25 to 6.75, that would get you at a low case valuation of about 10 billion. So you can start to see why the bonds are trading where they are. They're now near par or about around 90. But B, I think also, more importantly, why the rights offering, and I think the ability to participate in the rights offering, those are probably going to be key points in this case, because I think depending on what your view is on airlines and the multiple and what have you, I suspect that there are a lot of people out there that do believe that there's equity value in this structure. So that's enough rambling from me on the assumptions and value and valuation metrics with regard to LATAM.
Yeah, thank you. That all very helpful for thinking about just kind of what ranges of value are at play here, and how that will inform the positions people take in the case going forward. So thank you. Maybe time to finish off. Ed, we'll kick it back over to you with Aeromexico. Maybe you could start us out with the cap structure.
Yeah, sure. I guess before going into sort of current bankruptcy status, quick overview of their cap stack. Aeromexico has just under 1.1 billion in DIP currently, consisting of a $200 million tranche A portion and a $800 million Apollo tranche B. Notably, Delta has decided its intention to exercise a $185 million option to purchase commitments from Apollo on that tranche B, which also notably has an equity conversion option to it. They have finance leases of slightly in excess of $1 billion, working capital and RCF totaling $350 million USD, senior unsecured dollar bonds, of which $400 million are outstanding, local peso notes or cebures, of which $258 million are secured and guaranteed, and $58 million are unsecured and non-guaranteed. And last but not least, approximately $1.2 billion USD of operating leases.
Great, thanks. So the current bankruptcy status, it's interesting. Aeromexico could have been the first of these three to get a plan on file based on when it originally had some exit financing discussions earlier in the year. But the main case parties, including notably Apollo, is that DIP lender with an equity conversion option, and the debtors have been in valuation material and plan process mediation since the end of July, early August. So they kind of lost that head start. But their plan exclusivity period expires on October 8th. So, I mean, similar to LATAM, they've represented they'll have a plan on file soon. We may record this, and then 5 minutes later, there's something on file. But what we do have, just in terms of disclosure about positions, is that in responses again to exclusivity extension, so not anything confirmation process related, but the unsecured constituencies, the UCC, a notes group, a claims group, have all voiced support for an exit financing proposal, which they say is premised upon a, quote, materially higher valuation than any other proposal received by the debtors, which would come from these two ad hoc unsecured groups and certain unspecified new money investors. And the UCC has said, oh yeah, we expect the debtor's forthcoming plan to be premised upon this proposal. Apollo has said, no, hold on. The valuation materials the debtors were supposed to give us under the final DIP order, the debtors say they gave them to us. We don't think these are sufficient, which sort of implies, maybe they would like a lower valuation at which to consider that equity conversion option, as would we all. So, Ed, given that we've we've got less disclosure on Aeromexico, what do you think from a valuation perspective? Is there anything we can glean from looking at information that is available in the market?
Yeah, and thanks, Sean. And indeed, we sort of have less insight into their business plan going forward, as compared to the likes of Avianca and LATAM. And to that end, sort of back in February, we looked at it and derived a sort of an enterprise value range in pesos of 446 to 55 billion pesos, or roughly $2.3 to $2.5 billion. And that was based off of a forecasted 2022 EBITDA of 7.8 to 8.6 billion pesos, capitalized at 6 times. Now, underlying those EBITDA assumptions at the time was the assumption that the company would recover to about 75% of 2019 capacity as measured by ASKs, and generate EBITDA margins between sort of 16 and 19% compared to 2019 margins of 21%. Now, since that sort of analysis was conducted, the bonds have traded up from sort of mid to high 30s at the beginning of the year to currently around 80s, which is indeed supportive of a higher valuation. And to that end, the company's total capacity recovery, both in terms of domestic and international capacity, is sort of at a combined 75%, with domestic recovery being already above where it was in terms of ASKs in 2019. So if we assume additional margin expansion to upwards of 20%, say plus or minus 2%, and near or slightly exceeding 2019 capacity recovery by 2022, we'd see EBITDA reaching roughly 12.6 to 14.8 billion Mexican pesos, or 611 to 728 million US dollars, which again capitalizes at 6 times. So that discounted multiplier would translate to an enterprise value of 3.6 billion to 4.36 billion, which is indeed more supportive of where the senior unsecured bonds are trading. What we do have a bit of insight into sort of estimated claims pool and pro forma cap structure, which the debtor provided back in May, indicating sort of a range, a GUC pool range of $3.25 billion on the low end and $3.95 billion on the high end, which was, I think, slightly higher to the tune of $1 billion than what the market expected. Nonetheless, the bonds continue to rally. And a pro forma cap stack showing as December 21st, 2021, a net debt figure of 3.84 billion, comprised of 2.4 billion in fleet debt, 507 million, in non-fleet debt, approximately 190 million in sort of miscellaneous other, and the DIP 200 million tranche 1 and 921 million of tranche 2, plus 385 million in cash. Notably, there's no, conspicuously, there's no reference to the unsecured bonds, assuming or indicating that the assumption at the time was that they'd be equitized. And if we take that sort of enterprise value estimate of 4.36 billion, that would translate to a sort of 520 million in equity, assuming that the DIP is repaid or taken out in full by the contemplated exit facility that's being touted by the trio of unsecured creditor groups.
Great, thank you. So yeah, I guess there's still a couple open bullets. Sort of whether and if so, how much of the DIP claims elect to convert to equity, or if they're just taken out. Curious to see whether and how much new money is maybe involved from this. These new money investors that the unsecureds have said are in their group. Sort of some constraints with Mexican foreign investment law that could impact where the equity goes to. So hopefully we'll get a plan on file soon for this one. But thank you very much for running through it.
Thank you, Sean.
Well, and Kyle, again, thank you for taking the time to chat through these names. Should be some fun confirmation processes to follow. Until next time.
Thank you, Sean, and thanks everyone for listening.
Thanks, guys.
Thank you again for listening to this Reorg Weekly Review. Find all our podcasts on the reorg.com webinars and podcast page, as well as Spotify, iTunes, SoundCloud, and Amazon. Hope your families are healthy and safe. Have a great weekend, and see you next Friday.